Another thing I always get, so the one question is asking about the 100,000. So that's going to be based on taxable income. So depending on adjustments and how that works. So you might have someone that makes 100,000 on a W-2, but there's some adjustments. They're going to, or let's say 103,000. Are they going to be subject to a phase out? Generally, someone that makes 150 probably doesn't have enough phase outs to get them down below the 100, unless there's some other weird things, some substantial business losses. You've got the W-2 guy and he lost a bunch on a flip. You could probably get under that 100. Then I see a question on real estate professionals. I'll kind of cover that a little bit more. Real estate professionals, a beautiful thing, and sometimes something to be aware of. So, that'll be further on. Then there's a question about 1099 wholesalers. So, with the title company, you've never actually generally taken possession or paid that wholesaler. So if my client bought a deal and goes to the closing table with the purchase price, and then the wholesaler gets the fee, I would argue they never paid it. Somehow it was a transaction that the title company, if the wholesaler received it, I would say recognize it and pick that income up. If it's the situation that I get the proceeds and then I'm going to pay the wholesaler, absolutely you have to 1099 them. But if you hadn't paid them and you came to the closing table with net, I have clients that kind of do a little bit of both. Generally err on the side of not giving it because they don't necessarily always have that W-9 information, and I don't know that that wholesaler necessarily has that obligation to give it to you either. So, but let's see. One question I get, which expenses are deductible? All expenses related to your business generally. And as I talked about the different buckets earlier, which ones, because they all fall on different lines on your return. So biggest mistakes real estate investors make: deducting items in the wrong place, then really what business they are in, W-2, investor or landlord, limitations on passive losses, rules versus real estate professional status, then really lack of proactive planning. Now on your rental properties, really starting to advertise that property for rent the day you close from a service date. If we're talking a full rehab, then on a full rehab, you're going to have some time. But if we're talking that I'm going to have about 30 days, I would say start advertising that property right away. And that's really going to be more of an in-service date. Another thing I see quite often is needing an LLC to get started. Those of you new investors, get out there and get started. And you can, as you get a deal, maybe right before you get to the closing table, we can get there. But I see more multiple LLCs or series LLCs, or some guru sold a course on CS and all this stuff, and you end up with all this tax compliance before you've ever done a deal. So I like to find that proper balance. So but again, not having a structure that's going to give you the guidelines to fit everything into what we talked about previously is going to be key. And then also, those of you with partners, really getting things spelled out for the legal disputes. get it all in writing at the beginning, anticipate the worst, and you generally are going to have a great relationship with a partner. So more some more on the mistake side, again, on structure or accounting for depreciation, more on the escrow payments if your lender's paying that, and then really not using all the tools such as 529 plans for your kids if your business is large enough to start to take advantage of those and make those worthwhile. And then also some of the other opportunities such as 1031s and that. And then one question that came in, structuring LLC or corporation if you're a new investor. It really depends what you're doing from that investor. Are you looking to wholesale or flip? I would say more maybe on a corporate side sometimes. With an asterisk there. If I'm a buy and hold investor, I would say absolutely every time, all day, put it in an LLC because of the cash out refinance option. A lot of people I see do it in error through an S corporation, and that's actually causes a taxable event with a distribution in excess of basis. Could actually probably spend another hour talking about that, and maybe if people are interested, I could do a video on that or have something on that. But really, from the buy and holds, from a tax standpoint, you're better off individually or an LLC than you are to ever put it in a C corporation unless you're a public REIT or an S corporation. So here's some bookkeeping best practices. I think I'm probably just include this in the slides I can send to everybody. It's really the biggest thing is separate bank accounts and credit cards that I really like to, more times than not, I see personal accounts used, multiple credit cards. Treat your business like a business, I like to say. And I could maybe spend more time on bookkeeping for those that are needed. I think someone mentioned bookkeeping and QuickBooks, and maybe set up another time for that. We could probably spend another hour on that someday. So I'm kind of looking at the questions. It looks like some of the future changes, I think, just as we're getting pressed for time, don't mean to be skipping and I think that's some of the interest. Let me see here.
You see the question from Vicky at about 740, the non-recourse loan.
Okay, sorry about that.
I just thought they're all important questions.
Okay.
That was asked twice.
Okay, so here's a great question. Purchasing a property in a self-directed IRA with a non-recourse loan, then keep it as a rental for several years, and during that time you pay off the non-recourse loan from the rental income. The next year after the non-recourse loan is paid off, you sell the property at a profit. Do you still owe the UBIT, which is the unrelated business income tax on the profit? Honestly, I don't have that answer off the top of my head because with more on the buy and hold, the clients I deal with that have self-directeds are more on the lending side or buying properties not subject to debt because of the UBIT issue to begin with. It's something I could definitely look closer at, but I don't have the actual answer. I would believe it would not be, but I can't really conclude on that right now just because I don't deal with that and tend to, on the buy and holds and dealing with the recourse debt, it's a situation I wouldn't recommend for every investor, and it can easily get screwed up. So don't have the answer on that, Vicky, but I think as you're aware of, there's very strict rules with that if you don't follow those, it could trigger your whole situation being taxable. So I actually don't have any that have that situation, so I
That's
can't
why
answer that.
I put it out there to ask it twice, just because I haven't seen, it's something I haven't heard discussed about people keeping money out of their self-directed IRA long enough for it to be a long-term, long enough to pay it off with rental money. So I didn't know you could even keep money out that long. So
Well, with the self-directeds also, on the rental properties, at that future appreciation, if it's a Roth vehicle, it's going to be something that's not taxable. And based on the current tax laws right now, with buy and hold and refinancing and 1031 exchanges, you can effectively defer taxes indefinitely till death. With an IRA, that appreciation on that property, when you sell it, you effectively can't refinance that and take those proceeds tax free. So that's why sometimes don't see investors that they're more lending money in those situations and not necessarily on the buy and hold as frequent. But again, do everything you can do to get started and use the tools you have.